In this video, we're going to look at cash versus profit. Have you ever heard business owners wondering, why is the business making profits, but there is no cash? Or some owners wonder, why does the business have cash, but is still making losses? This is because some transactions affect cash, but not profit, and some transactions affect profit, but not cash, and some transactions affect cash and profit differently. Here is one example. The owner contributes cash to the business. This capital contribution will increase cash, but since it is not revenue or expense, it will not affect profit. Here's another example. Inventory gains will increase revenue and therefore increase profit. However, since it is not a cash transaction, it will have no effects on cash. In this third example, there was a credit sale of $10,000 plus GST, and the receipts from accounts receivable was only $6,000. The credit sale will increase revenue by $10,000 and therefore increase profit by $10,000. On the other hand, the receipts from accounts receivable will increase cash by only $6,000. Here we can see examples of transactions that affect cash but not profit. In the first table, we can see that drawings, loan principal repayment to the bank, GST settlement or GST paid, and cash purchase of non-current assets all lead to a decrease in cash. However, they do not affect profit at all. Therefore, we will have a situation where we have low cash but high profit. In the second table, we have capital contribution, loan from the bank, and GST refund or GST received, which all increase cash. However, they do not affect profit. For this reason, this leads to a situation where we have high cash but low profit in the business. Here we have transactions that affect profit but not cash. In the first table, we have inventory gains, which are revenues. However, it does not affect cash. This will lead to a situation where we have high profits but low cash. In the second table, we have examples such as inventory loss, inventory write-down, bad debts expense, and depreciation expense, which all decrease profit. However, they are not cash transactions, and therefore there are no effects on cash. This leads to a situation where we have low profits but high cash. Here we have examples of transactions that affect profit and cash differently. In the first table, we will look at examples that lead to low cash but high profit. Firstly, we have receipts from accounts receivable at $6,000. However, the credit sales made in the same period worked out to be higher than the cash received at $10,000. This will lead to high profits but low cash. In the second example, we have payments to accounts payable and cash purchases of inventory totaling to $9,000. However, the cost of sales expense recognized in the same period were lower than the cash paid at $5,000. This leads to high profit but low cash. In the second table, we will look at two examples that lead to high cash but low profit. Firstly, we have receipts from accounts receivable totaling to $12,000. However, the credit sales recognized in the same period worked out to be lower than the cash received at $10,000. These will lead to low profit but high cash. In the last example, we have payments to accounts payable and cash purchases of inventory totaling to $4,000. However, the cost of sales expense recognized in the same period were higher than the cash paid at $5,000. This leads to low profit but high cash. Sometimes the timing of when cash is received or paid may be different to when the business recognizes revenues earned or expenses incurred. In the first example, on the 1st of January, the business made a prepayment of rent totaling to $12,000 for the year. However, on the 31st of January, the business has recognized rent expense that has been incurred of $1,000 for the month. So for January, the business is going to be reporting low cash but high profits. In the second table, we have two examples that will lead to the business reporting high cash but low profit. So as at 31st of January, the wages expenses that are incurred for the 4 weeks that the employee has worked total to $4,000. However, $1,000 has not yet been paid and is reported as accrued wages. So for the cash, as at 31st of January, the business reports a payment for only 3 weeks, and that's $3,000. In this case, the business will be reporting higher cash but low profits. In the second example, as at the 31st of January, the business has received $5,000 as a 50% deposit from the customer for a contract sale. However, as the sale is not yet finalized by the end of January, we cannot recognize the $5,000 as revenue earned. On this note, in that month, the business will be reporting high cash but low profits.